Not so fast. Maybe this rebound isn't quite as smooth as we'd thought and, yes, hoped. This is Bloomberg Wall Street Week. I'm David Westin. This week, Afsaneh Beschloss of RockCreek on the risks for investors as Beijing clamps down on U.S. ownership of Chinese companies.
There have been some conversations about limitations on U.S. investors in buying the equities in China that are related to the government.
And special contributor Larry Summers from the site of the G20 finance ministers meeting in Venice on what the world needs to do now to avoid the next pandemic.
This is the public sector equivalent to buying Amazon in the 1990s.
Everything was going so well. We were all starting to get back to the office and eating in restaurants and going to parties. The economy was snapping back into place, and we were adding jobs at a brisk, if not entirely satisfying pace. But then this week, some doubts started to seep in. The Delta variant of the COVID virus led to shutdowns in Israel and Australia and threatened the Tokyo Olympics. We didn't make our goal of 70% vaccinated in the United States by July 4.
Today, we are closer than ever to declaring our independence from a deadly virus. That's not to say the battle against COVID-19 is over. We've got a lot more work to do.
And we reached the grim milestone of 4 million deaths worldwide, with the pace accelerating. Some economic numbers started to soften at least a little bit, and bond yields took a big step back, with the 10-year heading down below 1.3 rather than up toward 2.0, the way people were predicting not very long ago. At first, stocks shrugged it all off, but by the end of the week, they too were beginning to show some doubts. And here to take us through the markets and what they're trying to tell us, our Wall Street Week contributor Afsaneh Beschloss, founder and CEO of RockCreek, and Nathan Sheets, PGIM fixed income chief economist. Welcome to both of you. Great to have you back on Wall Street Week. So, Afsaneh, let me start with you. I start every week, frankly, reading your RockCreek note. And when I went back and looked at this last week, at the beginning of the week, we were all thinking about, well, is inflation here? Is it not here? Is the Fed going to have to clamp down? What happened this week? Because it seemed like the bond markets, at least, started to think maybe growth isn't really coming the way we thought it was.
Well, I look forward to hearing from Nathan on the bond markets. But what is interesting this week is it seems like we went to somewhat more of a balance. You remember we were talking about reflation trade. We were really, really concerned about inflation. And the Fed itself started sort of, I wouldn't say changing its tune, but saying that now the tapering might in fact get pushed into December, which is much later than what we had expected, which could have been in June or earlier than that. So we saw a shift in both numbers, but also in the psychology of the markets. But the more important thing, which was really interesting, is we saw the markets up today, of course, across many of the US markets. And what you're seeing is more of this balance, people sort of hedging their bets on both sides. And you're seeing that people are starting to buy tech again, but also trying to sort of be on the defensive also with value. And that might be the tale of the next few months as we go ahead.
So, Nathan, as Afsaneh suggests, you really know the bond market terribly well. I mean, we watched the equities really go down. They came back up, as Afsaneh said, at the very end of the week. At the same time, the 10-year yield got back up to about 135 or so, but still, it was down quite substantially. Was that technical? Is that a technical bond trading issue? Or was it reflecting something more fundamental, and particularly maybe that Delta variant?
So I believe that there were some technical issues. You had some folks that were short who were shaken out of the market this past week. But I also think there are some very important fundamental effects and factors. The Delta variant is one. Another is we continue to see relatively soft data come in from China. That was supported toward the end of the week by a monetary policy easing by the PBOC. And kind of putting this together, I think the markets are kind of concluding that, yeah, we're going to have a strong recovery and growth going forward is going to be solid. but it's possible that the most rapid growth in this recovery is now in the rearview mirror. And that means a little less inflation risk. That means the Fed can be a little bit more patient than it seemed a couple of months ago.
So, Afsaneh, is that right? A little less inflation risk? Because certainly that appears to be what the markets are reflecting. At the same time, I'm not sure I saw a lot of economic data that would suggest that's true.
You're absolutely right, David. The short-term inflation risks are still there. But I think, as Nathan said, the longer term, I think, seems to be more believable by more. As you know, just a few weeks ago, every story was about inflation. Every story was about it's going to get out of control and the Fed needs to do something about it. And that completely changed. And so basically, as Nathan said, also this peaking of growth in the US, if that happens to be the case, I think very much supports the idea that longer term inflation fears may not be as bad as we think. But also, if inflation does get a little higher, there is so much time to take charge of it and to control it.
So Nathan, decouple, if you will, on the one hand, inflation, on the other hand, growth, because we have some issues with supply chains that, as far as I can tell, are not going away. They could give you inflation whether or not we get real growth. In fact, those challenges may hold back growth.
So, David, broadly speaking, the incoming data are still pointing to those inflation risks. But looking forward, I think the markets are trying to read some tea leaves. And maybe over-interpreting what's happening in the world. But some PMI measures that we've had over the last couple of weeks have kind of suggested that maybe some of the supply chain tensions are topping off and maybe even starting to reverse themselves a bit. The Baltic Dry Index of commodity shipping costs has kind of leveled out and maybe down a little bit. Commodity prices, with the important exception of oil, which is a special factor, a special case, commodity prices, broadly speaking, have leveled off. So I think that the markets are saying, well, maybe we've now reached peak growth. They're seeing these early signals that maybe the inflation cycle is breaking, but we don't have those data yet. And could the bond market yet be surprised by the way the data evolve? And could we see new manifestations of the inflation process going forward? Maybe services-driven inflation, absolutely. So lots of risks out there, but I think the markets kind of are seeing a bit of a break, even with the inflation process.
Afsaneh, given your background in oil and the energy sector, I'd be remiss if I didn't ask you about what happened with oil this week, because it looked like OPEC was going to have a problem. There was a disagreement between the UAE and Saudi Arabia, which at least surprised me. But normally, if there's a problem with OPEC, it might mean you get more production, not less. So what made the oil price shoot up?
I think two things were going on. One was the technicals in the oil markets. And obviously, as economy has taken off, everyone is consuming more. So there's that effect. But as you said, the UAE and Saudi in particular, but also the other members of the OPEC were having a little bit of a fight over who gets the slight increase in allocations that OPEC had already decided on. And it seemed earlier on that this decision had already been taken, everyone had agreed, but UAE came back because they had increased their production capacity by quite a bit and wanted to increase its share. And the Saudis felt that if they allowed that to happen, everybody else will ask for increased share, which obviously would open the door to more disorder. So to me, though, what it showed that even with that spat going on, and even with those stories being in the news, yes, oil did go up. It did go up to 75 or around 75. But the bigger issue is it didn't go beyond that. And the story has kind of fizzled out of the news, even though it's still going on. The issues have not been resolved between them. And probably with the kind of summer we have in front of us, there will be more travel with cars, more travel with planes of different sorts. And so there will be increase in demand somewhat. But what we also see is that people are seeing it more as a short-term phenomena. again, like the inflation story that we just talked about. These are more short-term phenomena, not long-term phenomena. So people, we don't see a long-term increase in oil prices as being something that will be permanent. And I think it will go down to the 60s once this gets settled one way or another.
And Nathan, finally, for this segment at least, talk about emerging markets, because typically if the rates are going down in the United States, that's a good news for emerging markets. Certainly they came down, certainly well off the 175 or so they were. As I say, they were at 135, went down to 125. Is that good news right now for emerging markets?
The emerging markets, on the one hand, very much benefit from a strong global recovery, but they have really struggled with some of these global inflation pressures. And as a result of that, we've had a half dozen emerging market central banks hike rates over the last couple of months. And we've seen an increasing divergence between central banks in the advanced world and in the emerging markets. And that's been a concern. Importantly, perhaps another inflection point. I mentioned that the PBOC cut its reserve requirement within the last 24 hours. And that may actually give some of these emerging market economies that are a little less enthusiastic about moving toward rate hikes, a little bit more ground cover or air cover to continue with stimulative policies.
Nathan Sheets of PGIM and Afsaneh Beschloss of RockCreek will be staying with us as we take up the question of investing in Chinese tech companies in a week when Beijing rocked Didi's world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. When Chinese ride-hailing company Didi went public last week, it was the second largest listing for a Chinese company on record. But this week, things went south quickly when the Chinese government clamped down on Didi and other big Chinese tech companies, raising questions of how much political risk comes with Chinese investments these days. Still with us are Afsaneh Beschloss of RockCreek and Nathan Sheets of PGIM. So, Nathan, you know China terribly well, as does Afsaneh, I must say. But give us a sense, Nathan, of exactly what you think's going on, because before this, I thought that China basically wanted access to U.S. capital markets. They wanted investors' money here. But what the Chinese government's done this week makes me doubt that.
I've learned over the years that moves by the Chinese government have multiple interpretations and need to be viewed through multiple lenses. Does China want Western investment? Absolutely. But they're also balancing that consideration against geopolitical and other kinds of considerations that they have. I think that they see these actions as retaliation against the Biden administration and against the United States for a pressure on Chinese firms listed in the United States to submit to U.S. audit policies. I think it's also a signal from the Chinese government that they want to be in control of the data generated by the firms that are operating with headquarters in China. And they're putting controls and restrictions on how that data is going to be used. So I think all of this is at work simultaneously. And we're seeing that in this ongoing thrust and parry between the United States and China, that tech is now really becoming the beachhead for that confrontation. With Donald Trump was more trade policy. I think for the Biden administration, it's much more about these tech firms.
And Afsaneh, as Nathan suggests, data seems to be the hostage in that conflict between the United States and China right now. But I wonder, for you as an investor, is a Chinese investment, certainly in a publicly traded company, is it less attractive today than it was 1 week ago?
So, David, I think Chinese investments are equally attractive today as they were before. I think even before, you had to be cognizant that the Chinese government could change, as we've seen in other emerging markets, but China obviously in a very, very different way, could change the rules and regulations. at any point in time. So when you look at your risks and returns, you have to weigh those all the time. In fact, with Didi, they had really given sort of their intention and put it out in the market after the earlier huge IPO, as you remember, when we saw them crack down also earlier on Alibaba. And what they did is they went to Didi and they said that they really didn't want Didi to list on US markets. And Didi shareholders and the entrepreneurs who had started it decided that they wanted to do it. And of course, for the Didi founders, it meant that they could get paid in US and not get their money stuck in China if they had done their IPO in China. So they saw their advantage, and they sort of seemed to have taken some sort of a calculated risk, if that, to do it here and risk that 20% decline that we saw right away. And I think what was really surprising to me was not just the decline after that, but more importantly, why did Didi stocks go up today when the Chinese government put more limitations on their and more limitations on data on Didi? So I think looking forward, I see the Chinese markets on the public side and the private side being both affected. The big question is a lot of the big Chinese companies that we're seeing now going IPO are companies that the Silicon Valley firms such as Sequoia and others supported in their early stages and seeded. So will the US venture industry continue to seed these companies if they don't go IPO in the US? I think that's a big question to me.
That is a great question. Nathan, I want to come back to you and ask you, and it's related to this, but a little bit different. Can you put a ring fence around tech here? As you said, Chinese government decisions tend to be multifaceted. It's hard to make them very simple. But to what extent is this really specific to tech, specific to the data issues you raised? And to what extent is it more broad, as you suggested, having to do, for example, with access to audit papers of publicly traded companies in China?
I really worry that this is a broader phenomenon. I think that we are now at a place in the United States where being tough on China is seen as an end in and of itself. The new restrictions that we put on Chinese firms, the new measures that the United States is putting on China are not expressed in a way where it also explains what China will need to do in order for these restrictions to go away. They have a feeling that it's just a very kind of permanence associated with them. And similarly, the retaliation that the Chinese are putting in place feels like it's likely to be something that is long-lived. And my sense is that Cold War is probably not the right expression, because I don't think we'll see the military overtones. But it's going to be a fraught coexistence in the economic and financial space between these two global superpowers in the years ahead.
So, Afsaneh, maybe not a Cold War, maybe not strictly speaking a decoupling, but maybe a partial decoupling. Are we seeing something that, frankly, was begun in the Trump administration that is continuing here? And if so, what does that mean, not just for U.S. and China, but for global growth overall?
We saw it towards the very, very end of the Obama administration. Remember the stories about how tech was kind of maybe decoupling, maybe, we weren't sure about that. And then during the Trump administration, obviously on questions of trade, where it wasn't just the US, but really the rest of the world also felt that trade had been conducted such that with WTO and others, the Chinese had been able to increase their trading power while they had limited trade coming into China in a very big way. We're now seeing the same phenomena to me. And I think, as Nathan said, we have to look at everything in China in 3, 4, 5, or even more dimensions. The Chinese, on the one hand, have a very maybe long-term plan to have the renminbi as a reserve currency. But in the short run, that obviously, with all the actions we saw this week, is not part of the short-term plan. So they have the long-term plan and the short-term plan. On the short-term plan, they want to keep the rules based on the way they would like the markets to be conducted. And the way they do that is exactly what we saw with sort of the ruling this week with Didi. We'll see other things, probably more limitations on the one hand. The other side of it, though, is that they also want to let their citizens have some air to breathe. So they're letting them again start investing in outside markets, outside of China. So you see them limit certain things for a certain time and then open up certain other windows for their own domestic investors with the strong connect to invest in Hong Kong and maybe in the US or elsewhere with that $50,000 limit that they have for them. So it is, as Nathan said again, many, many different dimensions at the same time, which can confuse everyone. But there's no question that there's one thing which is the most important to President Xi, and that is to be able to tell the large companies that he's in charge.
That makes sense to me. That I can certainly agree with. Many thanks to Nathan Sheets of PGIM and also to Afsaneh Beschloss of RockCreek for that great discussion about China, what it did this week with respect to Didi and what it means for investors. Coming up, we take a look at the week ahead on Global Wall Street. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It is time now for a look at the week ahead on Global Wall Street.
David, China's GDP report for the second quarter headlines the week amid signals that the pace of the recovery is slowing on the mainland, which prompted the State Council to discuss the possibility of a triple R cut to support the economy. And as South Korea grapples with rising COVID cases that have placed Seoul under tighter virus curbs, the BOK is to decide policy. It could be the first Asian central bank to hike rates this year, but taking a hawkish stance this month is looking harder in light of the outbreak. Now, the RBNZ is also up to bat and will watch for clues on normalization and no change expected from the BOJ, but it may trim its growth forecast for Japan. Danny?
Thanks, Sophie. Well, after the G20, Yellen heads to Brussels for a Eurogroup meeting. We also get a financial stability report from the BOE, and on Wednesday, the EU lays out their plans for a new Green Deal. Romain?
Thanks, Danny. The second quarter earnings season kicks off next week with reports from the biggest U.S. banks, including Goldman Sachs, JP Morgan, Citigroup, and Wells Fargo. Also look for earnings from United Health, Delta Airlines, and PepsiCo. Economic data during the week include the monthly consumer and producer price inflation reports, industrial production numbers, and figures for retail sales. Fed Chair Jerome Powell also will be in the spotlight when he appears before a Senate and a House committee on Wednesday and on Thursday to give Congress an update on monetary policy. David?
Thanks to Sophie, Danny, and Romain. Coming up, the finance ministers from the 20 largest economies in the world met this week in Venice, even as the number of worldwide deaths from COVID reached 4 million. So the question is what the G20 can do to address the biggest economic risk that is out there, the threat of not getting COVID under control everywhere. We talk with Shah of the Rockefeller Foundation about what it would take to get not just the United States, but the entire world up to that 70% vaccinated mark. That's next on Wall Street Week on Bloomberg. The COVID-19 pandemic took a toll on the world's health and economy. At the pandemic's onset, governments worldwide imposed restrictions on business and travel to contain the spread of the virus.
We will see more cases and things will get worse than they are right now. It is 10 times more lethal than the seasonal flu. The flu has a mortality of 0.1%. Sure. This has a mortality of 10 times that.
The measures disrupted the world's economy and caused massive job losses in many service industries. Governments rushed to provide stimulus as central banks eased monetary policy.
We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing from the Congress and the Treasury.
By the end of last year, pharmaceutical companies and governments had come together to develop vaccines faster than anyone expected. But rates of vaccination around the world are still uneven. According to the University of Oxford, 25% of the world population overall has received at least one dose of a COVID-19 vaccine. But that includes a range of from over 50% in North America to just over 1% in Africa.
We provide clear and compelling case for accelerating vaccinations everywhere.
The health crisis is now easing in much of the world, and many countries are rolling back their restrictions. Some countries, including the United States, have scrapped mask mandates for those who are vaccinated.
We'll move away from legal restrictions and allow people to make their own informed decisions about how to manage the virus.
The latest setback in the global recovery is the Delta variant, which stoked a dramatic wave of COVID cases in India. Now, the variant accounts for over half of the new cases in the United States.
In today's briefing, we discussed how the Delta variant is already responsible for half of all cases in many parts of this country.
The highly contagious variant sent Sydney back into lockdown and is threatening the Tokyo Olympics. Japan plans to declare a state of emergency for Tokyo as the Delta variant spreads in the eastern part of the country.
What we want to do is give us our best chance of making sure this is the only lockdown we have until the vast majority of our citizens are vaccinated.
Dr. Shah and his team at the Rockefeller Foundation have developed plans for addressing the pressing need for vaccinations in low and middle income countries and how to help their economies recover. We welcome now the president of the Rockefeller Foundation, Dr. Shah, back to Bloomberg. Dr. Shah, thank you so much for being with us. First of all, tell us about where we are on getting the world vaccinated. I know you have a plan. I think it's $49 billion required to get 70% of the people around the world vaccinated by the end of 2022. Where are we on that plan?
Well, we're doing fairly well in wealthy countries, David, and it's great to be with you again. But it's just as your piece indicated. You know, Africa has a total population of above 1.3 million people. Just over 1% are vaccinated. India, another 1.3 billion people, 5.1 to 7% vaccination rates. Latin America, maybe, twice that, but still quite low across a population of almost 800 million. So the reality is there are billions of people in lower income countries that are quickly becoming a huge reservoir for viral replication. And as now we see the Delta variant is the dominant variant in so many places around the world, that is just going to keep replicating and keep threatening the precarious gains we've already made and could undermine this global economic recovery and could cause a new wave of death and lockdown in wealthy places that think COVID is over or is behind us to some great extent.
Raj, where are you on the $50 billion? 49, just to be precise, $49 billion, because we've been talking about this for a while now. You've had that plan out there. We now, for example, have, as I understand the IMF, moving forward with I think it's $650 billion in issuance of new special drawing rights. Will that help take care of the problem?
Well, yes and no. As you point out, the Rockefeller Foundation pulled together experts from around the world and estimated about $49 billion would get a 70% herd immunity vaccination rate in the 92 low-income countries, poorest countries in the world. And, that would save the world economy $9 trillion in losses if we don't do it. So it's an incredibly good ROI investment. The IMF has made important steps forward, but they still have, probably 4 to 6 months before those resources start to hit and improve vaccination on the ground in those countries. And there's some complex steps that still need to happen. The G20 finance ministers are meeting right now in Venice and have a unique opportunity to take the shackles off of the multilateral development banks, the World Bank, the African Development Bank, the Asian Development Bank, and give them the capacity to greatly expand rapidly their lending to low-income countries. Yesterday, the Rockefeller Foundation put out a report illustrating how to do that by changing the capital adequacy requirements of those institutions to put potentially $700 billion to $1 trillion of lending into lower income countries that are going to be the front lines of the global defense against COVID-19 and the global aspiration to have an equitable recovery.
Yeah, and Raj, I want to make a distinction if it's the correct one. I think it is. On the one hand, we have to get everybody vaccinated, get up to that 70% number worldwide. We also have to help these countries restore their economies. And that's somewhat separate from that. And you do have a plan with the multilateral development banks. As I understand it, maybe freeing up as much as $1 trillion for investment?
That's exactly right. These banks were created after World War II in the famous Bretton Woods Agreement. They were created to help much of the emerging and developing world achieve some degree of economic convergence, catch up growth with wealthy countries on the basic idea that stability, growth, economic activity, and opportunity for everyone is deeply stabilizing for the global economy. Simple concept. The reality is they've been deeply constrained through this crisis. We illustrate how, if you look at 2019 versus 2020, multilateral development lending to low-income countries has not increased their rate of growth on an annual basis and stayed around 6% growth, whereas during the global financial crisis, it was much, much higher than that. This is a global financial crisis for the emerging world, and both because resources are needed to vaccinate everybody and because you need big fiscal expenditures, as you see in wealthy countries, to recover. And neither of those things are happening right now. And so we call for bold action right now from the G20 finance ministers in Venice.
And Raj, just a final point here. As I understand your proposal is you might try to kill two birds with one stone. That is to say, in a lot of this lending in these middle and lower income countries, you would actually put it toward climate change investment.
Yeah, that's right. I mean, look, never waste a crisis. And the reality is, if we want all of the world's economies and not just a handful to join a climate agreement at around 1.5 degrees Celsius, building on what the Biden administration has put out there, there has to be some pathway where countries believe they get resources to invest in lifting up the living standards of their people and do it in a green, renewable, clean manner. And this is that opportunity. We see green recoveries being a big component of the EU plan. We know it's a big part of the Biden bipartisan infrastructure bill in the United States. It should be a part of the package that's offered to the 92 poorest countries in the world. And just like after World War II, the ministers came together and said, let's create the basis for dealing with the future challenges the world faces. That's what the opportunity the G20 finance ministers have right now, and I very much hope they'll act.
Raj, just briefly here at the end, I always ask the same question, when? What's the timeline? How fast could you get that money out?
Well, both the IMF action and the action around the multilateral development banks would have to be agreed to by finance ministers now, approved in board meetings this fall, and probably really start to disperse aggressively in Q1 onward of next year. And that's probably in the current system about as fast as you can go in order to do something bold and transformational. We did not see these kinds of leadership actions happen a year ago. And as a result, in 2020, we don't see huge new funds flowing from wealthy countries and the community of nations to the 92 lower income countries. It's urgent that we not repeat that mistake that was made, and we act boldly now so that 6 months, 9 months, 12 months from now, we're in a whole different environment.
Thank you so much. Always great to have you with us. That's Dr. Raj Shah. He is president of the Rockefeller Foundation on their plans both to get the world vaccinated, but also to help those economies come back. Coming up, we wrap up our week by going to Venice, where a special contributor, Larry Summers of Harvard, is at the G20 finance ministers meetings, helping to plan for the next pandemic. This is Wall Street Week on Bloomberg.
That this one has gone so far has to mean there's a substantial chance that it's the one for this half century or this century. The second wave of the pandemic was more than 50% worse than the first wave. I personally doubt what I think is the market's view, which is that we're going to have most people vaccinated and life returning to normal sometime by spring of next year. When you look at Latin America and Africa and even parts of India, You're going to be looking at a lost decade. To have that kind of effort requires the international system to step up.
That was our special contributor Larry Summers warning us as far back as February of 2020 right here on Wall Street Week just how bad this COVID-19 pandemic could get. Sadly, Larry was all too right. And now what he's doing is he's co-chairing a special high-level independent group for the G20 to try to give some advice on what we can do to prevent the next one, or if not prevent it, at least deal with it much more effectively if and when it happens. And we're pleased to go now to Larry Summers of Harvard, who was over in Venice for the G20 finance ministers meeting. So welcome, Larry. Great to have you with us. You've worked hard, obviously, on this report with your colleagues on the group. Give us a sense of what the need is right now in planning for the next pandemic when we're not quite done with the current one.
David, I'm glad to have a chance to be with you. Look, I've seen a lot of global good causes that require investments to achieve international objectives and strengthen the international community. That's familiar. Here's what's special about this moment and this problem. The costs on an annual basis are in the low tens of billions of dollars. The benefits, if we prevent another COVID, are in the tens of trillions of dollars once you add up all the various costs and all the various remedial measures. So that could be 1,000 to 1 in terms of the annual cost versus the benefit. So the stakes are immense, and the stakes for Americans, for Europeans, this isn't just a moral issue, though it is that, with respect to poor people in poor countries. The greatest threat we have of decreased life expectancy in the United States is not war. It is a health emergency like COVID, which has seen an unprecedented decline in U.S. life expectancies. What should be done? We highlight three broad issues. The first is that we need much better governance. We don't have a system right now. We have a lot of separate institutions and a lot of separate funds and a lot of separate efforts and no political oversight. That's the way financial regulation was before the financial crisis, and that's why the world established the FSB, Financial Stability Board, to provide a much stronger and coordinated kind of governance. And while it's not perfect, we're doing much better in terms of global cooperation and financial regulation than we were. And we need something that will bring together finance ministers and health ministers to make sure that we have much more coordinated and rapid responses in the future than we had this time. Second, the international financial institutions really need to step up in a major way. I congratulate the IMF and Kristalina Georgieva, its head, on the agreement on a major SDR allocation, special drawing rights, that was agreed this week. That's a hugely important step. But we're going to need much more creativity, ingenuity, and commitment from the international financial institutions than we've seen. They were conceived and brought into being at a time when problems were in individual countries, and we needed to support countries in responding to critical issues. That's still important, but our largest challenges are increasingly global and global public goods, and the international financial institutions are going to have to step up to that challenge, and that means the world's finance ministers, the group that's here today, are going to have to give advice to the leaders of the major countries on how exactly that should be done. So the second priority is that the international financial institutions need to step up. And third, nations are going to have to commit resources if we're to be in a reasonable position the next time a problem comes. I think it is closer to right to suppose that we were lucky with respect to Ebola, with respect to MERS, with respect to SARS, with respect to H1N1, that those prove to be limited problems. I think that's closer to right to believe that that was lucky than to believe that the world had some spectacular misfortune with respect to COVID. And with the incidence of these things coming, we just need to be committing resources so that never again will it take months to procure adequate masks. Never again will there be a lack of data on the problem as it unfolds. That we will find vaccines even faster next time, and even more important, that they'll get disseminated far more effectively than is taking place this time. So this is a problem that can be solved. We can't eliminate epidemics, we can't eliminate sickness, but we can very substantially cut back the costs to the global economy if we just have the will to do it.
And that is the key question, isn't it, Larry? The will to do it. I mean, you're one of the people who has taught me that we tend to respond to crises when they're here rather than anticipate them and really provide for them in the future. What is the likelihood that will happen? We're not quite past the COVID-19 crisis globally by any means. What is the likelihood that the people that are meeting there in Venice will say, we're worried about the next one and will commit, I think it looks like $75 billion over 5 years, about $15 billion for core contributions. What are the chances?
That's right. That commitment's not going to come at this meeting, but I am guardedly hopeful as we look towards the leaders' meeting of the G20 in October. I'll tell you, this is the moment. This issue is in focus and on people's mind right now, when every day's headline is about the Delta variant or the Lambda variant or whatever. Inevitably, attention will pass. And so if we don't take this moment to think about future prevention when the crisis is in view, it's never going to happen. I hope it will happen, and I think there are a lot of people who feel the impact of what has happened. And again, we're talking the low tens of billions of dollars in order to save the low tens of trillions of dollars. So it's about as easy an investment return choice. This is the public sector equivalent of buying Amazon in the 1990s. And the public sector doesn't get served up many of those opportunities. And so I sure hope the world's governments will take it.
Larry, this is clearly a priority. You call it a clear and present danger in your report. There are also some other priorities, and let me be very direct. Is there a willingness and a capacity to both pursue this initiative on the pandemic, on the one hand, and the climate change issues? Because there's another big issue that many people will say is a clear and present danger. I think you might say that as well.
They're both absolutely critical issues. They've got somewhat different parameters. This could strike in a major way at any moment, including next winter. The climate change issue is planetary in a way that this issue is not, and is on a very long fuse. Sometimes there's no alternative to walking and chewing gum at the same time, and this is one of those times. I do think they have in common the need to build a resilient global system. And they have in common that the threat to security is resolved by global cooperation rather than by balancing power. And that's really the big new paradigm here, David, that it's achieving cooperation rather than balancing power that is the realistic need for global security. And I hope by putting them in that frame that we will make these necessary investments, because as profound and as important as they are, they're a lot cheaper than what everybody's accustomed to spending on military equipment to balance power.
Yeah, well, certainly buying Amazon in the 1990s sounds pretty good to me, I must say. Thank you so much to our special contributor, Larry Summers of Harvard, joining us from Venice. Coming up, one more thought on the controversial Chinese practice of lying flat. This is Wall Street Week on Bloomberg. Finally, one more thought. Boy, that was quick. 50 years ago this weekend, National Security Advisor Henry Kissinger took his historic, and boy, it was secret, trip to Communist China to meet with Prime Minister Zhou Enlai as the first step in what became President Nixon's opening to China.
I think one of the results of our trip, we hope, may be that the walls that are erected, whether they are physical walls like this, or whether they are other walls of ideology or philosophy, will not divide peoples in the world.
In 1971, China's GDP was under $100 billion a year, way behind the United States, which had nearly $1.2 trillion. But in 50 short years, China has grown its economy, listen to this, over 100 times to more than $10 trillion a year now, becoming the second largest economy in the world and closing fast on the United States in the #1 position. So how did it do it? The old-fashioned way, through enormous hard work, the ambition of its people, and a fair amount of moving people from the rural interior to the urban coast. But today, that may just be starting to change. Where in the 1960s, Timothy Leary was urging America's youth to tune in, turn on, and drop out, today the equivalent Chinese mantra is Tang Ping, or lying flat. Begun 5 years ago by a 25-year-old factory worker named Luo Huazhong, lying flat is spreading through the youth of China. Tired of the long hours, they've decided to take it easy, giving up their jobs, living modest lives off of their savings, and yes, sometimes off of their parents. As you might imagine, this doesn't sit very well with the older generation. President Xi insists that struggle is the way to go. The government is shutting down online groups advocating lying flat. One newspaper writes, quote, "The only way to ensure a happy life is if one works hard. Lying flat is not only unjust, but also shameful." However it all ends up, it does underscore just how far China has come, from subsistence living to demanding more out of life than a house and a car, all in just a little bit more than a single generation. And I must say, without the love beads and the psychedelic mushrooms. Back in the day, we used to say, "Come the revolution." But, oh yes, in China, they already had their revolution, didn't they? That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.